Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts Josh Shellick and Colin White, portfolio managers with Verecan Capital Management, Inc.
Welcome to the next edition of Barenaked Money. This is Colin with you with a very special guest, Lisa Kramer. I'm very proud and happy to announce that Verecan has taken the step of funding a research chair at the University of Toronto. So I'd like to introduce Lisa Kramer, whose official title is the Verecan Chair in Behavioural Finance at the University of Toronto. So welcome, Lisa.
Thank you.
I'll give a little bit of a context as to why we've gotten involved, and I'll be quiet and let the smarter person in the room do more of the talking. This is part of our goal to, advance the conversation that people are having around money, and behavioral finance is something that is very important that doesn't get enough air and people don't talk about it enough. So this is kind of our effort to bring it to the forefront and gain a bigger audience and talk about some things that are very, very important and not well understood. So we did our research and we found Lisa's work, and we're very impressed with the body of work and the kind of work she's been doing. So we wanted to get involved. So Lisa, maybe you can describe a little bit about your background and how you got involved and why you got involved, and take it from here.
Thanks. It's really great to be here. And I'm so proud to be the inaugural chair in behavioral finance funded by Verecan. So thanks for having me. And I do work in the area of behavioral finance, which generally speaking takes insights from psychology and applies them to the context of economics and finance to try to better understand how people make financial decisions, all the interesting things they do, guided by their emotions and their impulses, sometimes costing them money. We like to think about the financial aspect of the decisions people make, investors, as well as other financial market participants. So I've looked at even professionals in a whole wide range of financial contexts, different kinds of asset markets, individual decision-making, aggregate market outcomes. And I've been working in this area since I was just a wee little PhD student, rebelling against the norms at the time, and really happy that I kind of followed my nose and did what I thought was interesting, because I still think it's interesting. And these days, a few more people also think it's interesting. So that's validating.
Well, that's true. And maybe just for a second, we can geek out. If you could just, comment on the differences between behavioral finance and behavioral economics, which are still relatively new ways of thinking and talking about stuff that is fighting against the establishment for recognition. I was more familiar with behavioral economics, and I think that came a little bit before behavioral finance became a thing. Maybe you can comment a little bit on the playing field and like where this has all come from and where it's maybe sitting today.
For sure. So behavioral economics is just broader. In behavioral finance, we narrow down into the financial aspects that are kind of a subfield of economics. So economics more broadly, if you're looking at behavioral economics, you might see people doing experiments in developing countries, trying to see how you can combat poverty and get more people access to education, for example. In behavioral finance, we'll look more at the decisions that households make about whether to spend or consume today, and how investing aggregates up to help people in their retirement. We'll look at corporate finance contexts, the kinds of decisions that CFOs make, and making decisions between debt and equity financing, and does human psychology play a role in those kinds of decisions. So it's just a narrower slice, but behavioral economics and behavioral finance are definitely cousins.
Well, yeah, and I think that's kind of what drew us to this, because this is the maybe more applicable part when it comes to financial decision making for individuals. And I think this is where we can make some progress in raising awareness. Now, again, sometimes you raise awareness with people and it doesn't always help, because if you really like chocolate, you're going to eat too much chocolate, and maybe that's outside of your control. But the hope is maybe we can, point out some things to people to help them understand themselves a little bit more in their decision making.
Some chocolate is good. Like, we don't want people not to eat chocolate. And similarly, we don't want people not to be human. Like, we're not aiming to turn people into robots. We're humans, we have emotions, we have impulses. We just want to understand when we act on those, what might happen, and are we okay with that? Maybe sometimes we want to rein in the effects of some of those aspects of human nature. But it's a bit of a trade-off, and we're not aiming for perfection, and there's definitely nothing wrong with being human and having behavioral finance tendencies.
Yeah, and for the record, Verecan is in favor of humans and chocolate both. We're anti neither. But it is an interesting because none of I think the topics lend themselves to really firm rulemaking per se. It's more of a general awareness. One of the things that I think, and again, I've done a little bit of reading and research on some of your stuff. The work that was done on sunlight and how that affects general decision making and how that manifests itself in financial decision making. I found it very insightful from the perspective of understanding that if you think you're a rational person, well, we've actually proven that how much daylight you're getting is potentially going to influence how you make decisions. And maybe that's not all rational. So there are things outside of your control. Is that a reasonably fair observation of that kind of work that you did?
It started a couple of decades ago. We were interested in what kind of phenomena line up humans to behave in similar ways at certain points of the year. And we stumbled on the idea of seasonal depression. And of course, we're humans, we absorb light through our eyes, and that affects our hormone production and at the end influences our willingness to take financial risk as it happens, something we learned as we were doing. And, with lots of people in a location, a hemisphere, in fact, being aligned in their risk preferences, this can also align the kinds of securities we do or don't want to hold. And this really plays out in a huge way in just about every facet of financial markets, much to our surprise over decades of work. So, it really is something that is pervasive. Just, a fraction of people suffer extremely enough to be diagnosed with clinical depression due to these seasonal fluctuations in daylight exposure. But most of us, maybe experience winter blues or something during the darker seasons. And most of us probably experience some degree of changes in our risk preferences seasonally. So this turned into a much huger set of projects really than we envisioned when we started the work.
Were you able to establish a magnitude? Like, is this a very marginal difference, or were some of the results more dramatic than maybe one would anticipate?
It's huge. So if you think about the fact that the equity premium, the reward you bear for holding securities that expose you to the market risk compared to safer securities like treasuries, you might get a 4 or 6% equity premium. This effect amounts to about a 6% difference in the annual return you get in the darker seasons versus the lighter seasons. So huge in terms of magnitudes. And the way we sort of estimated this, we looked at a bunch of different countries, and our hypothesis was that if daylight is affecting mood and risk preferences, then countries that are further away from the equator should have bigger mood impacts and then bigger sort of behavioral impacts. And indeed, we found for countries that are much further away from the equator, like Sweden, the effects were bigger. And then when you looked in the Southern Hemisphere countries, the effects were out of sync by 6 months, just like the seasons are. So that was an identifying set of tests that were validating. And when we did a little thought experiment using historical data, which isn't always predictive of what's going to happen in the future, but if we took a portfolio and invested it 50% in, say, Sweden and 50% in, say, South Africa, and compared the rate of return on that portfolio to one that moved the money seasonally to be 100% at one extreme versus the other, the difference in those two portfolios was even bigger than 6% a year. So what can happen in any given year is anybody's guess, and I'm not trying to tell anybody to develop a trading strategy based on this. But, over a long period of time, what we notice historically is very, very large seasonal effects.
Well, yeah, and I guess I was going to chime in from the practical side of the world. I mean, because we've gone through, more intense globalization and the flow of capital around the world. So people of various geographic locations are investing in, the geographic boundaries are not quite the same. So, and the other thing is if Russia invades Ukraine that morning, maybe that's going to be what moves the market that day rather than the fact that people are a little sad. So it's always from a practical perspective, and thank you for getting to this isn't a trading strategy, because that's where I was going to go. But I do think that it has tremendous value to recognize that kind of magnitude in your own mood, which I think is the kind of the goal, or where I want to shine the light on. So if we can make individuals aware that, there's very, very strong proof that this does absolutely affect mood. Now, it's not a trading strategy, to be clear, and make sure we don't get in trouble or go to jail. But to be aware of that in making your own decisions, I think is very, very important, and something that really could make a difference in somebody's situation. Let me ask you an unfair question. What kind of strategies would you think would be effective to help somebody prevent, the kind of fluctuations in optimism, if that's the way to put it? What would you say to somebody who was trying to say, okay, what tools can I use to not have that affect me as much?
Sure. Well, I would start by saying, even if you're tempted to try to reallocate your portfolio, even like within a geographic area, there's still no like free lunch in this. It's not like you can move your money between bonds and stocks at different times of the year and somehow outperform, because we do still observe that stocks are always riskier and always have on average a higher risk premium than safe, say, government securities. So there isn't even a market timing aspect to this within a geographic area. But beyond that, more to your question, I think recognizing that we're human and anticipating that at certain times of the year, we might be really tempted to make big changes when we're feeling more risk averse and bad economic news comes in. Knowing that in advance and sort of strategizing ahead of time can be really helpful. So one way to do that is like to develop a plan and stick to it, like not looking at your portfolio every time, distracting things are happening in the news can be one coping mechanism. Another is if you find yourself to be really impulsive and prone to trading reflexively when things get frothy in markets, it can be helpful to have an intermediary between you and your portfolio. So a trusted advisor can be helpful to kind of walk you through those moments, because even if they're also human, they do probably tend to look at your portfolio a bit differently than they would their own, and probably take a longer term view on your portfolio because that's in their professional best interest. So these are some of the things that come to mind.
I guess what springs to my mind is if I found myself in, January or February not being very optimistic about things, go, wait a second, am I really not optimistic about things, or am I just in a bad mood? At least, internally asking yourself, or July and August, like, hey, I'm going to go swing for the fences. I'm feeling really optimistic right now. Again, maybe just wait a second, is that really me talking, or is that the sunshine talking? So no, I think it's tremendous the amount of work you've done to quantify this and make it a real thing, because this is one of those ones that you could suppose is an issue, but until somebody such as yourself makes, and your colleagues and everybody else that's worked on this work puts the effort in to say, yeah, it's a real thing, now we can use that for make for awareness, so people are a bit more aware that this is one of the effects they have, and hopefully more properly aligns their confidence with their ability to behave as a rational human being. Because maybe you're not quite as rational as you thought. What else are you thinking is interesting, or what else from your journey would you like to talk about that would be helpful for people to maybe ponder themselves?
Yeah, I mean, I definitely wasn't the first to do work in this area, behavioral finance or behavioral economics. There are just giants on whose shoulders I stand, and we could talk all day about some of the interesting results that have been done. I came to the area kind of by accident myself. I just found myself disillusioned with the kinds of things I was learning in my PhD studies. They were important building blocks, but they just weren't really exciting to me, and I kind of got a little despondent about the idea of a career working on what was being done by most people at the time in academia. So I just kind of followed my own sense of what was interesting. And the first project that I worked on looked at daylight saving time changes and whether losing an hour or gaining an hour of sleep twice a year had any kind of influence on decision making in financial contexts. So we had read a book by Stan Corn. He's a UBC psychologist looking at just the impact of sleep on things like the Exxon Valdez oil spill and the Challenger accident and 3 Mile Island accident, and sleep and shift work and things like that were perhaps involved in those massive crises. And we just thought, like, what about financial markets? And we took a look, and sure enough, the trading day following a time change, there's actually a big downturn in markets on average. Again, don't want to predict what's going to happen on any given day, but on average, markets perform a lot worse on that first trading day after time changes. And, we didn't really test a specific mechanism, but what psychologists call sleep desynchronisis, or changing our sleep patterns, is associated with certain cognitive changes, maybe anxiety. And so this could be what's going on. But yeah, again, we were really surprised by the magnitude. When we looked at US markets on each trading day following a time change, there was in aggregate about a $30 billion loss in markets. And that seems to be standing the test of time. Just on average, those trading days tend to be not great.
Yeah, and again, the reason that this doesn't make a good trading strategy is that's one of many forces that play in the market that day, and other economic information can overtake the market in a very short period of time. So I want to keep saying that over and over again. I'm not for a second dismissing the value in what we're talking about, but I just want to make sure nobody has got an opportunity to take a soundbite and say, hey, here's a trading strategy. I want to make sure that they have trouble cutting me out of there saying it's not a trading strategy.
And to be clear, I also don't pursue these as trading strategies. Like, it's just, these are too risky to try to implement. It's just academically, it's interesting to try to understand what's happened historically and think about psychological reasons that might happen. But absolutely, what's currently going on in the economy can completely swamp these effects.
Yeah, exactly. And I think that's probably one of the reasons that this doesn't get as much play as maybe as it should, is that it's nuanced, and nuanced conversations often get drowned out by less nuanced conversations. So what else is cool? What else is hip? What else is happening?
I'm working on a bunch of new research projects. It was exciting in the last 24 hours because I actually worked on 3 different projects with 3 different sets of collaborators. Yesterday was a 12-hour day. And so it's exciting at this stage in my career still to be working on things that I find interesting. And just like past work I've done, it's all very eclectic, but yeah, definitely still actively researching different ideas. One of the papers that I was working on just in the last day, it's still looking at seasonality in mood and financial markets, but this one is actually using high frequency data from financial markets. Like, think of each order as it comes into the market, each trade as it happens. We just have a decade of this high frequency data on every order that gets submitted, whether it's executed or not. And what we're looking to see is whether this behavioral seasonality in risk aversion is showing up in the cost of liquidity. We're looking at the spreads between bid and ask prices and how these move around in time. And even though these kinds of markets are today really heavily dominated by algorithms, we're still finding these human behavioral effects, which some people find surprising.
So is that because humans design the algorithms, or because there's still enough human influence that the algorithms are reacting to the residue of human activity in the market? Is there any way to parse which that is, whether we've just created algorithms that we've given a seasonal affective disorder to?
I
That'd be
think
funny.
I think there is some of that happening. I think that algorithms are created by humans, and maybe as well, maybe a bigger factor could be that algorithms are often overridden by humans. So we do know that at these institutions that do a lot of the high frequency trading, they do often override what the programs say. And that's a pretty great way to impart human tendencies into financial markets if you're overriding your algorithms. And
Those were
definitely we think the algorithms do also impart some bias as well.
Well, I think for those afraid that the robots are about to take over, it's probably still good that we override them every once in a while.
I don't think that robots are going to remove the behavioral from behavioral finance.
Well, that is interesting because you would think that there is a school of thought that we can rationalize this away if we just get to a point where we let the system behave rationally. But I don't think that's the human condition. I don't think we'll ever be able to completely remove ourselves, because these are so ingrained. Uh, and again, we could go for days. You're going a whole career just looking at the different ways the human brain causes itself pain. Well, how interesting is it for you, I guess, that the proliferation of the available data, like, are you finding there's more and more data that allows you to chase more and more interesting questions, or is the data too proprietary and too locked up for you to get access to what it is you're looking to research?
There is a lot of locked up data that would definitely be exciting to get my hands on, but I usually think of research ideas that I should be able to see just looking at markets. Like if they're not there in aggregate, then I don't know that I want to spend a lot of my time exploring them. So usually as a bit of a sniff test, I take a look to see what is just evident to the plain eye. And then we can throw some of the heavy duty econometrics at the question and maybe proprietary data if we can get our hands on it. But as a first pass, I like looking at problems that are evident to the eye.
Interesting. So what is the next question, or what is the next thing that you are curious about that you're allowed to talk about? I assume there's some stuff that's probably too new or too different or too currently locked up, but is there something else that's on your desk that's outside of the realm of the seasonal affective disorders and associated? Is there anything else that's there?
I've been just definitely working on projects that are sort of an extension of what I've worked on in the past for the most part, but I do dabble in other ideas. So one paper that has started a bit of a newer research stream for me, we published the first paper just last year looking at the effects of racism, basically, and how it affects decision making by households. So there's an area called household finance that's very closely related to behavioral finance, where we're looking at the decisions that get made within the household about how to allocate money over time, spending versus saving, and questions about whether households participate in financial markets to sort of compound their saving over time and have more money available in retirement. My collaborators and I are looking at how different aspects of racism can influence the way different racialized communities don't achieve as much as they could. So the paper that we published last year looked at racialized police violence. And so think of those horrific stories that show up in the news once in a while where an African American dies at the hands of the police. We look at the people who live in that community and their race and the kinds of financial outcomes that they have subsequent to that traumatic event. And we can see differences in the way that they participate in financial markets, to the detriment of the members of the African American community, for example. So in that paper, we looked at two of the biggest components of household wealth, which are retirement savings and your home. And we saw adverse effects in both of those for the African American communities compared to the white community members where those events occurred. So that's sort of a new stream of research for me. We're continuing to look at some related questions there. It's still very preliminary, some of the new work we're doing, but there's a lot of data available to investigate questions like these, and they haven't been fully explored to the extent that I think they should be.
Well, that's really interesting. It's like, if there was some solid findings there, there probably would be some policy implications from, that kind of work, which would be very exciting to see. And I guess just to understand it, like, because I been witnessing and dealing with the general public, there are all cultural differences with how different cultures deal with money. But I think what you're looking at is a racialized group, inside an actual culture that is experiencing the true effects of racism rather than just a cultural difference in how money is approached. Is that a fair observation?
Yeah, absolutely. And in studies like this, we have to be really careful to properly control for the fact that different communities have different customs, different levels of trust in financial institutions. That's been well documented by a lot of researchers. So we have to find clever ways to make sure that we're not being fooled into finding a result by those kinds of well-established tendencies. So that's why these projects sometimes take years to complete.
Well, absolutely, because there's always one more question. If you're truly curious, there's always one more question, right?
Oh, yeah. And there's always one alternative explanation that somebody points out that you didn't think of, that you have to make sure you carefully control for so that you're
Yeah,
not reaching, unsupported conclusions.
interesting. And I think you made a comment, or I read something that you're also looking at the effect of even natural disasters on different communities and the effect that that had in the subsequent decision making for a period of time. Is that something that I read accurately, or am I misremembering something?
That might be the next recipient of the Verecan Chair in Behavioral Finance. That's certainly work that
Oh,
I've read about, but I haven't myself looked at natural disasters. In some of my work, we've controlled for different types of weather phenomena, but it's usually like whether it's been snowy or rainy or cloudy. But there's some great work that's been done looking at natural disasters for sure.
what would you comment on the problem of overconfidence in decision making? Is that something that's come close to your world as far as taking a look at as a contributor to poor decision making? You know Somebody who has too much confidence in making their decisions, that they think they have full information and proceed with too much confidence. Is that a thing?
Yeah, absolutely. It's a huge thing, and it can be very detrimental to one's portfolio to be under the influence of overconfidence. So when I teach behavioral finance, we have various tests for various types of overconfidence, and it's always kind of fun in the classroom to have students, explore their own degree of overconfidence and then kind of document that 70% of the class thinks that they're an above average driver, for example, which is one of the easy ways to show overconfidence. And then looking at the kinds of detrimental effects that this can have at the portfolio level. So some studies in finance have shown, I'm thinking of the work of Terry O'Dean and Brad Barber, who were really the first in this area. They showed that overconfident investors, measured by how frequently they trade, tend to underperform other traders. So when discount brokerages first became available, they got a hold of the data, and they could look at how frequently every investor traded. And basically the ones that trade too much, they think that they've got great information and they're trading, every time they think they're buying low and selling high. And maybe they are, usually they're not. But even so, all the fees that they were paying in commissions, end up eating away at their return. And so on average, they ended up underperforming relative to everybody else. So that really hits the bottom line.
Well, yeah, and I always challenge people who are behaving overconfidently. It's like you understand the game you're in. Like the smartest minds of the world have put trillions of dollars to work, and they trade in increments of picoseconds. And you read the Globe this weekend, and you think you have information that you can trade on that nobody else has figured out. Optimistic might be a way to describe them, but again, it's part of the human condition, and I guess part of the problem is the world kind of panders to that. Like there's Thaler was quoted on a podcast I listened to one time that it's way more profitable to take advantage of somebody's weakness than to fix them. And the industry, I think, really, the world, and I don't think this is a financial industry thing specifically, but just panders to that. Like it's like, I know what I'm doing. Sure, you do. Here's a trading account. And they let, because it's a lot more work to turn that person around and say, no, you don't know what you're doing. That's a lot of work, and you may piss them off, and that's not the way. So there's all these opportunities that kind of feed into those things that we get to watch regularly. And it's,
Absolutely. And you see some of the new trading platforms that are using gamification to
oh my
really
goodness.
exploit people. Gamification in and of itself doesn't have to be inherently good or bad. Gamification can be used to promote investor education, like give people badges for learning more. But no, we have confetti when people make a trade and incentivize people to trade frequently and do things that aren't necessarily in their best interest. And it's really disheartening to see.
The advice we always give people is just understand the business model of where you are. Like if you're in the room and you didn't pay to be there, you're the product now. Just as long as you understand that, that's the first step to protecting yourself. So if you're in that room, you didn't pay to be there, and they've got a gamification system running, that's in their best interest. Somehow they're not doing that for free. They're doing that because they're getting a return on it. And like some of these free trading platforms for sure are very, very good at, again, the confetti thing, or here's top 5 traded stocks. Here's the top 5 growth stocks. And they just produce endless lists. And I believe the research has been pretty conclusive that will influence trading frequency and what people will buy based on it's a popular list and people want to take part in it. Have you seen a good example of gamification that is for the forces of good? I'm kind of curious because you're right. It could absolutely be used for the forces of good, but in my professional career, I've never seen what I would call really good gamification trying to promote good behavior for the average investor.
Yeah, I haven't really seen it deployed by any for-profit company. It's usually proposals from government adjacent groups, like nudge groups that are trying to deploy behavioral kinds of concepts to promote good decision making. That usually comes from the nonprofit sector. They have great ideas, but then you try to get companies to implement these sorts of things, and all of a sudden they ask, well, how are we going to make money from this?
Yeah, they engage for the virtue signaling aspect. I was like, yes, we're very concerned about this. We're talking with these people, but when push comes to shove, I guess maybe that's the inevitable problem they're going to run into. But I think it's something that really, really could make a difference if there was a way to get that, that kind of reinforcement and get those kind of dopamine hits for doing the right thing in a system. But I'd be kind of curious. We'll do this offline. If you could point me in the direction of some of that research, I'd be very interested to see if there was, what is there, and try to participate in a solution as to where that could be used, and try to find a way to get that out there.
The way some institutions, I shouldn't throw every institution out with the bathwater, but there are some subtle nudges that many companies have started using, like setting up automatic transfers into retirement accounts and things like that, so that you are remembering to save every month without having to actually take any action, sort of automating things like that. But that's pretty low-hanging fruit, and it's not gamification, which is what you asked about.
Yeah. Oh, it's interesting. Well, fair enough. Well, I tell you what, why don't we leave them wanting more? And I'll say thank you very much for this. And I listen, I want to give you full credit, because I know when we called you initially to approach you about having this conversation, you might have thought we were crazy, because this is a completely new idea, as far as I can tell. And you've shown an immense amount of courage to engage with us on this topic. So we're looking forward to working with you to try to elevate the conversation, and maybe get away from some of the other conversations that's occupying everybody's mind right now that's maybe not as productive.
Well, I look forward to continuing that conversation.
Thank you very much.
If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening. Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.